Today's video is about HDFC Flexi Cap Fund. So it has begun on 1st January 1995. The present fund manager is Roshi Jain, and she has been managing since July 2022. So in a Flexi Cap Fund, their mandate is to invest across Nifty 500 companies. It can be either a large cap, mid cap, or a small cap. If you look at their strategy, they want to invest in strong companies which can emerge stronger during challenging times, right? And they have a good amount of diversification. It's across the sectors so that they minimize the risk. So they are saying their exit load is 1% before 1 year. So since this is an equity scheme, ideally you should not invest for anything less than 5 years. So if some investor is getting into this with a time span of 5 years, then exit load shouldn't even matter to you guys. The benchmark they are using, they are stacking against is Nifty 500. Obviously, this is a flexi cap fund. So since you are investing across the sizes of the companies, it makes sense. The AUM presently they are managing is around 64,125 crores. The direct expense ratio is 0.81%. The regular is 1.43%. So if you are somebody who is going with a financial advisor, if he or she is charging around 0.5% plus GST, then that would come around 1.4%. So if the charge is more than 0.5%, most likely you will end up paying more than what you pay for a distributor. So let's look at the analysis. So the data I could gather is from 2013 January. So that's what is available in the Google Finance. So I've compared it across the time horizons on a rolling return basis. So this is for the direct regular. So I have looked at the Sensex, Nifty 50, Nifty 100, and Nifty 500. So the outperformance has happened across the time horizons. If you look at the median returns across the time horizons, it's over 16% here, and even on the regular side as well, it has done extremely well compared to the Sensex, which has done around 12%, and Nifty 50 around 12%. But again, you have to understand in the last 10 years, especially after 2014, mid cap and small cap have actually done better than the large caps. So especially after the COVID. So in a way that would have boosted the performance. So that's the reason why you have to check with the Nifty 500. So when compared to Nifty 500, the alpha it has generated is approximately 3% per annum, which is actually huge if you consider a 10-year horizon, right? So at the regular level, this is around 15.84%, and here it is 13.85%. So this is the 1 percentage point, 2 percentage points higher. Here that would be 2.7 percentage points higher. So essentially, you are foregoing that 0.5% to 0.7% to your distributor in case of regular mode. So, but if your distributor is somebody who's helping you with goal planning and then the asset allocation, and he or she is regularly interacting with you to understand the changed financial conditions, and at the same time explaining why this fund is good for you and why you should have to invest. And if he is very actively reaching out and if he is doing all this stuff, then it makes sense to pay whatever you are paying, the 0.7 or 0.2 or 0.5%. Same is the case for the financial advisor. So, but if he is doing none of this, then it makes more sense if you are doing it directly, understanding this fund and doing that. So let's just look at the performance of this fund. So from 2013 to present day. So from 2013 to 2017, it a five-year period. So if you look at it, if somebody has started in 2013, so in 2016, the returns would have been something similar, right? So the fund has outperformed between 2014 and 2015, but again, there was a steep correction which was there. So it was maybe due to the AQR, and maybe at that point of time and demonetization and all that stuff. Maybe at that point of time, the fund is holding the companies which got affected due to this. Again, this is more of a speculation. So, but from 2016 to 2017, you can see the performance gap, right? So from 2018 to today, if you look at it, from 2018 to 2023, mid of 2023, the outperformance is not much. It has pretty much tracked the index. But again, from mid of 2023 to present day, the gap has opened up. So if you look at the two time horizons, right, the fund started performing in the year three. If you look at it, 2013 to 2016. So 13, 14, and 15, the performance has been same. From 2016 to 2017 ending is they have generated a higher return. Even if you look at 2018, So for the 5 years, the fund has been quite just like the index, but in the last 2 years, it has done well. So that's the reason why sometimes when you are going with an active fund manager, you need to have a longer term time horizons. And at the same time, you have to believe in the thesis of the fund manager as well. So if somebody is just comparing between these two timelines, then obviously this fund will look like an investable fund. So, but ideally, that's not the case, right? So over a longer duration of time, the outperformance can be huge, right? So if somebody has invested in 2013, so Nifty 500, the benchmark is they are saying it has delivered around 440. 100 rupees would have become 440. On the direct side, this would have become 650, and on the regular side, it has become 630. So it's a 50% absolute higher returns. Okay. But you have to believe in the fund manager on the active side. Index wise, like it is just a churn which will be happening. So here you have to look. That's the reason why whenever there is a non-performance in a fund, it is a good practice that you check what is the underlying there, what kind of stocks he or she is holding, right? And sometimes that particular sector may underperform for a longer duration of time than expected. So whenever the performance turn happens, that's when you'll start enjoying a better returns. So after the change in fund manager, so from 2022 onwards, from the time she has begun, she has delivered good returns. The name of the fund manager is Roshi Jain. So she has done well. But again, this is a short period of time from 2022 to 2025. So that's just like 3 years. So again, there is a high chance that after 3 years as well, the fund may come back to the index level. So don't try timing the market. That's what people tend to do. They try to enter here, they try to enter here, seeing the performance of the fund, and eventually you will end up, looking at your performance here, which will be a lot higher. The negative return will be a lot higher compared to the index. That's the reason why you have to look at the rolling returns, and that has to be across the longer time horizons, how it has done. But that's when, if you can compare, that's when you will understand that this fund would have done better. This video is for educational purpose only. It is neither a recommendation to buy nor sell the mutual fund in discussion. You have to do your own due diligence, and it has to be according to your asset allocation, and it has to be something which suits your uh, financial goals. Thank you.